in my world, when I break a story about an AI startup or a new round, it's so interesting to look at the cap table. Traditional venture capital, but also people like you coming in more in the private growth equity space. Would you just talk a bit about that business model and what you try to do?
Sure, and thanks for having me on today, Ed. Appreciate the opportunity. So the way we position our strategy is to operate like a traditional venture and growth equity investor. So we start investing at the earlier stages of a company's formation, Series B through pre-IPO on the technology and consumer side, all the way through that last inflection point before going public. I think for us, we seek to leverage the whole firm to deliver value to companies. And in a world where capital is just that, but value add in changing the inflection curve of a company's growth, de-risking, we think JPMorgan is well suited to be that partner of choice.
So interesting. You're talking about leveraging the full scale of JPMorgan, right, as your pitch.
Yes.
The traditional VC would say, don't just take our check, take our operators, our knowledge. Many of us are entrepreneurs or startup founders. Your pitch is, we're JPMorgan.
Yes, I think in the simplest of essence, of course, I think we're privileged to be part of an organization that spends $18 billion a year in technology spend. We have 63,000 technologists, and I think what is really important to recognize is we will work with companies across our firm as early as the seed stage. So we're on the hunt for exceptional technologies. Now, as investors, of course, first and foremost, we assess product market fit, the strength of the management team, but then where can we pair in those relationships covering 90% of the Fortune 500 or 45,000 private companies. So we have the privilege of those operators that other VC firms have, but I think the global footprint of a firm like JPMorgan.
What are you seeing in private markets right now?
Yeah, it's a complicated question. It depends on the topic, but let's start with where we see the investment opportunity set. I think for us, we're spending a lot of time in areas like artificial intelligence and cybersecurity, both incredibly resilient from a tech spend perspective. There was a recent review of chief information officers and chief technology officers' budgeting priorities, and I think for different reasons, you're seeing increased commitments to those areas. In AI, I think it's a world of now having gone from experimentation to actual deployment. Over 65% of companies are now deploying AI in their full production suite. Those companies are now automating tasks. They're creating efficiency and making a more delightful consumer and enterprise experience. In cyber, unfortunately, you could have a version of me that's virtually produced, my cadence, inflection, a little bit of my positioning, and you'd have to be able to protect against that. So that defensive posture is critical. It's why even in tougher macro environments, the defensiveness of the spend there is very clear. And so you'll see that reflected in some of our portfolio companies.
Some of your portfolio companies, we just showed AlphaSense, of course, the maker of Cursor, such a hot property right now. Tell me what's going on with that, but also Databricks. Like Databricks recently has been relying on tenders for like employee liquidity rather than a primary raise. How have you navigated those two mechanisms in these two hot names in the world of AI?
Well, let's start with AlphaSense, because I think that company, think of it really as a market research and intelligence platform that in 2008 had the idea of bringing publicly available data in the world of markets, also accessing the research reports that are put out by Wall Street firms, digesting that and giving research analysts, corporate development arms, as well as portfolio managers, the right solutions at their fingertips to make informed decisions. With the advent of AI, that's gotten even more acute and clear as to how they deliver value. And they recently acquired a company called Tegus, which provides private market perspective, so customer interviews that get transcribed. That marriage of data is critical to making better decisions. On Databricks, you bring up an interesting point. I think the evolution of the private markets are such that companies are staying private longer. In order to provide liquidity, they look to access this tender solutions and letting employees seek some liquidity. For us, we want to be active in names like Databricks, where it's critical in the world of infrastructure for AI, growing well in excess of the public markets with an exceptional management team. And so we're thrilled to be involved in both of those and think they're critical in this new advent of AI.
Patrick, we just have 30 seconds, but you see some kind of exit coming in either of those names?
Well, I wouldn't want to speculate on that too much. I think the management teams are better suited to do that. What I would say about the exit environment more broadly is we've gone from a faucet that's completely shut off to a trickle where you have companies like Hinge Health, ServiceTitan, of course, CoreWeave, that have used the public markets, which is important. Hopefully the back half of the year produces more of that. But they are companies that could effectively go public by virtue of their performance, again, the management team and the market size.